Hey guys, welcome to RIA Advisors Lunch and Learn. This is actually going to be through RIA Insurance. Everything here is going to be, just informational, educational, no specific recommendations. So please take everything with a grain of salt. Consult with your insurance provider or any of our people here. Chris Liebem will be certainly happy to help. I'm Danny Ratliff, Certified Financial Planner, here with Richard Rosso, CFP. We're going to get into a lot of information today. Going to be some things to digest. We'll be answering questions. So if you have any questions, go to the chat box. We'll be there answering them as we proceed here today. So want to jump right in. Introduction. What are we going to be talking about today? Lots of people, concerned about government intervention, concerned about how do you create additional funds or put aside funds that can potentially help you and give you some tax-free income or tax-free distributions. What is an area that's judgment-proof? How do you protect assets? Mm-hmm. And at the end of the day, how do you eliminate potential estate taxes? So we're going to talk about all this and more and go into some details on why these are all so important, especially in this environment. Rich, why don't you take us away?
Just a quote from Gerald Loeb, seminal investor, one of the best out there, about successful preservation of capital must overcome the handicaps of socialistic governments, supposedly there to help the masses. And the reason why this is in there, if you think about it, is many people worry about some of the tax-friendly status of insurance. And I will tell you, that is probably one of the biggest lobbyist groups in Washington. So I wouldn't worry about, Danny, anything changing as far as policy loans and the effectiveness of them. Sort of like what we talk about when people ask about Roth going away. Mm-hmm. Well, that's not going to happen. So we want people to understand that insurance is a powerful risk mitigation tool. It's a powerful legacy tool. It is a powerful retirement supplement tool. And that's what we want to provide this education to you to understand today.
Yep. And so I think that's a really good point, Rich. And so, the basics of life insurance, kind of the way that we envision this is that, initially it's there to mitigate risk. So you look at a term policy, you want to protect your family, hopefully a growing family. But as you age, you usually, you'll outlive that policy. And especially if you start to accumulate assets, or if you're looking for ways to accumulate assets that are out of the reach of Uncle Sam, this is where we can start talking about quite a bit more.
Right.
But, we want to back into that, Rich. So what does that mean when you're looking for, what does somebody look for when you're just setting up your general life insurance, if we're kind of progressing step by step?
Yeah, listen, it's tough to consider life insurance because we don't think we're ever going to die. But one of the things that we want to do is make sure that you look at the basics of the different types of life insurance and your consideration for dependents, their standard of living. Right? You want to look at also, how can I also help my retirement be better when you look at life insurance? So it's a bridge between the financial needs of your dependents and the amount of available from other sources, right? Because you can't look at life insurance, Danny, in a small scope. It's got to be part of a bigger picture. So we wanted to give you some general rules to understand these things, right? The highest and best use, obviously, for life insurance, regardless of whether it's a term policies, we'll talk about those in whole life, or permanent policies, you want to look at who needs to maintain their standard of living upon your death. And I know we're just never going to die. But these people have an insurable interest in your survival. A person has this insurable interest in something when loss or damage to that thing would cause the person to suffer a financial or other kind of loss. Very important, as you said, Danny, for growing families, right? When you have dependents. But once your dependents are no longer dependent, could they be used for wealth building? And that need for pure insurance or term insurance diminishes. So we understand insurance is made complicated. We want to make it as easy as possible. We want you to understand the basics, the skeletal basics of this for you to make the right decisions. So first is the simplest coverage. I call it the Alka Seltzer of insurance. Term coverage. right? Danny, you drop that. Do they even make Alka Seltzer anymore? They sure do. They used to make Bromo Seltzer, but that's before Danny's time. But you drop that fizzy tablet in, and it dissolves away. But term also dissolves away once its purpose is complete. It's well for a specific term. It's not all bad, so we want to cover the pros and the cons of term insurance. So what are some of the pros, Danny, of term?
I think the pros are the number one. It is probably the easiest life insurance to attain, especially because we're going to attach an expiration date on it. We're going to say it's going to be a 10, 20, 30-year term. I mean, we can switch the numbers up here. But usually it's going to be designed around a specific goal or need to mitigate risk, to help your family in the event of your passing or a loved one. And so I think that's a really important aspect of it. But, it really, we're looking for, we want to step back into this. So if you're thinking about the old school, rules of thumb, how do you attain life insurance? We start backing into those numbers.
Yeah.
How old are your children? What type of debt do you have? What are your overall just general expenses? What happens if you're no longer there or your loved one is no longer there? How do you help prevent creating a big financial disruption in your household? And this is where life insurance or term life insurance would come into play. So we like that guaranteed health or death benefit. Some of them will allow you to convert to a permanent policy over time. And I think that's a nice advantage as well. We hear a lot of bad things about permanent policies, and we're going to get into those here in a bit. But a lot of times the problem is that these aren't properly planned for, and that can be any of these. Term is typically one of the better policies for somebody who's young, in the sense that if you're just looking to mitigate that risk, that is a great avenue to do so. It's also the most cost efficient, right?
Very cost effective.
So another really cost effective way, and something you need to consider, is, does your employer have group life insurance? And this is one thing that I think is very important if you're going to go outside and purchase your own life insurance. Understand if that group insurance is portable should you leave your firm and you go seek a new job. Understand, if you can do that, what does that look like? What does the cost look like? And then that's another way that you can begin to back into what type of insurance you truly need. We find a lot of people are overinsured, sometimes, greatly underinsured. Like you mentioned, Rich, people don't want to address our mortality. And so it's something that we typically often, want to push to the side. Oh, we'll do it later. But getting through some information here, if you have any questions, go to the chat box. Rich and I are monitoring. So is Chris Liebem. Love to answer any questions you may have. But Rich, what are some of the cons of term policies?
One of the cons is when it's done, it's done. It covers this insurable need, and then it fizzles away. It's the ivory soap or the Alka Seltzer, as I mentioned, of insurance. And for some people, that's great, but it doesn't have a savings component, no cash accumulation, or loan features. Here are a few myths to keep aware of. Dave, this is a Dave Ramsey mantra, but a lot of financial advisors use this, and I think it's quite outdated. You pay less with term and invest the difference. Well, will you? I mean, all savings statistics say no way, right? And even if you fulfilled the Dave Ramsey rule, how would you do it? Compared to the interest on bonds, long-term CDs, the cash value of permanent life insurance can make it an effective long-term savings vehicle for retirement. Rates earned can easily be 5 times at least what CDs offer. And we're going to talk a little bit more about permanent life insurance. So remember, there are 2 roads, term and permanent, right? Permanent's to age 100, so it's not this Alka-Seltzer or ivory soap, right? It's a little bit more complicated. But you can accumulate money in a Roth, which we love, right? But you can only put so much in a Roth IRA. But I can also put the money into a permanent insurance. Some of that permanent insurance can be linked to the S&P 500. So you get a portion of that. It could be linked to a fixed rate that compounds over time. So we're going to talk a lot more about that. But we also have some guardrails for you to keep in mind. Because remember, we're here to give you rules so that when you make these decisions, you make the right ones. So here are some of our RIA guardrails for term life.
This is really important in the aspect of, you need to find somebody that actually is going to take this holistic viewpoint and understand all of your finances. So many times we hear stories where somebody just says, well, what's your income or what's your expenses? And then they back into a number that way. Whereas we need to think about what are the goals, what are the objectives that you have? Is your intent to provide for your spouse if something were to happen in your family, and then provide for college as well? Or is it just to provide, keep a standard of living? Mm-hmm. I think this is really important. The other aspect is that, when we find that a lot of people will go out and they'll go purchase a policy that maybe doesn't go quite long enough, where it doesn't reach all those goals. And we need to be very cautious when we're purchasing these types of policies. And, the one great thing about life insurance, Rich, is that if we shop around, we can likely find some pretty good deals. Yeah. There are ways to find those these days. I think that we need to be cautious because we want to make sure that we're dealing with reputable companies that will be there for a long period of time, because this isn't a one-time transaction. It's something that actually you're going to be paying for over time and likely for 20, 15, or 15, 20, 30 years. So we want to make sure that this company has good financial strength. AM Best does rankings, and it'll tell you the solvency of these companies and also give you, if they're superior, if they're excellent. And this is a very good way to kind of get a barometer and gauge, the financial solvency of each one of these firms.
So, Danny, most people would, not most, but some people say, I'll get the 10-year term for now. Mm-hmm. I'm 30 years old. I have a young child, and I'll get the 20-year later. But guess what? If you're 40, even though the term is going to be cheap, it's still going to be more expensive because you are older. And what if you have a pre-existing condition or something that happens in those 10 years, right? I would say plan up front and then purchase the right policy. Match the term. Like, when do I want this Ivory soap to just go down the sink, right? Correct. I want to match it to the goal. So don't just say, I'm going to get 10-year now and then wait 10 years and get another 10. No. Get it up front, because the younger you are, the cheaper it's going to be. Also, Danny, like you said, in your group policy, you probably have the ability to get much more insurance. The issue, what Danny mentioned, is very important, is the portability. If you left that company, and if you're a young career person, you're probably going to leave. We hear about it all right now, right? Mm-hmm. The Great Resignation, people picking up and moving to other companies. Is that portable enough? Or does the other company have group life? What about if you go out on your own? So you got to really look at this very carefully. So again, nothing wrong with term for young families starting out to get the maximum amount of insurance for the least amount of cost. But that's the dissolving one, right? But we want to talk about the brick of insurance.
Well, and Rich, real quick, I want to jump in. Yeah. At one point, I think it's okay for you to be overinsured, especially as you're younger. If you have a family on the way, or maybe you have some certain goals, or you want to have several children. I think you can go ahead and be overinsured at a younger age, and you could always bring that back down later and get another policy. But this will also help mitigate any potential for there being an illness that would prevent you from getting coverage. Right. You're also going to attain it at a much cheaper premium than what you would as you age. My policy, I know when I was younger, I actually overinsured for a time because I kind of, planning as a planner, we kind of look out in the future. And I thought, well, you know what? I think this, and this. And so here's how I want to go about this. And it was able to actually save money in the long run. And, for a while had a little bit more coverage than we probably needed. But it's worked out well in the event something happens.
Well, I'll give you an example, and that's a great point, Danny. I have someone who at 27 years old took out an $800,000 term policy that had the ability in about 10 years to be converted to permanent. Because we're going to talk about some of the drawbacks of permanent insurance, but what happened was once his need at 50 for that term went away, he took that $800,000 policy and converted it to permanent. He didn't have to provide any evidence of insurability, and he had cancer once. So what he did was, it's a lower face value. It went from 800 to 400, but now he's going to build up a cash value. So to your point, Danny, there's nothing wrong with looking at what can this term grow to or be down the road. And a lot of even single younger people go, why do I need life insurance? Well, what if something, God forbid, happens to you? Are your parents going to pick up your final costs your bills? Do you have a pet that needs to be taken care of and there's going to be financial implications? No matter what age you are, to have a little term insurance, and like you said, Danny, in anticipation of a family. What if I have a pre-existing condition before I have a family? You know, insurance to me is always there regardless of your age. You should be looking at it. It's just whether you're looking at your term or your permanent insurance and how much. So don't discount insurance because you're 24 years old and you're single and you're just starting out and your company offers it for dirt cheap, okay? Don't do it. So we talked about the Alka Seltzer. Now we're going to talk about the brick of insurance, permanent life insurance. This technically is designed to last a lifetime, up to age 100, but technically your lifetime. It's all weather. It's always there. It never dissolves. That's what permanent life insurance is. What are some of the pros, Danny, you think of permanent?
Well, that's going to offer the protection for you and your family. And, you know, the bigger part of this is that savings component. So going back to the Dave Ramsey school of thought there, that you only need term, you invest the rest. Unfortunately, like you mentioned, we don't see people actually go out and do that. But also in these types of policies, we generally don't see them use these properly either, because many times we just pay the premium. And what we should be doing is we should look at this as, you know, I love having a permanent policy in the sense of as a savings vehicle, as an accumulation investment vehicle versus the risk mitigation, so to speak. So you can use these for several different reasons, right? So the term policies, we're using this strictly to mitigate that risk of somebody passing early.
Pure insurance.
Pure insurance, that is it. A permanent life insurance policy is going to be used for either cash accumulation or cash accumulation and something to pay maybe potential estate taxes. We begin to see as people's wealth begin to grow, this is another avenue and something that we typically want in place. So this provides that guaranteed death benefit that term policy is not going to do, because remember, that term policy is typically expiring at a specific period in time. You know, I think the guaranteed premium structure, which means that you know what this will be. It's not going to increase over time. You could reduce or eliminate if the policy does well, or you overfund it. And ideally, these are policies that should be overfunded. You know, we hear these stories, Rich, where somebody says, and a lot of times somebody was sold this, and they don't understand quite the mechanisms of how it all works.
Right.
But they pay those minimum premiums, and they say, my cash value has never really grown. Well, really, we should back into one of these policies if we're looking for that cash value. We get sold this great product in the sense of, look, you can use it for education for the kids. You can use it for retirement. You're going to be able to take out a loan against it. And that's another tricky part. We can get into more detail and really caveats with each individual policy. But we want to make sure that we're doing it in the right way so that your funds can last a long period of time. And so what ends up happening is you just meet that minimum payment, and you never get that true growth or that acceleration of growth that you would want, because it's really going towards the expenses of life insurance and then a little bit into that cash value policy. What we'd like to do is back into the numbers, say, okay, I make too much money to contribute to a Roth, or maybe I've maxed out my Roth and I'd like to be able to put some more money somewhere else. This is where you'd actually overfund a policy up until it becomes, or before it becomes, a modified endowment contract, or what we call in the industry a MEC. And I think this can be really beneficial because this helps you accelerate that cash value.
Right. So listen, if you look to avoid the risk of stocks, but you want a greater return on your money, then you can go elsewhere with this, right? You can get better returns without downside risk. So this cash value, to Danny's point, builds up over time. You can borrow against it, right? Depends on the lending rate, but sometimes your returns could be above the lending rate. You grow a cash value within the policy. Could have dividends. It can. What's good about this, especially as you are a mature wage earner, right? You're at your peak earnings years, and we'll talk about some rules of permanent life insurance, some of our guardrails for you to consider. These build up over time. Also, Danny, what's popular as far as the tax deferred compounding that you get with these, I can add a rider to these permanent life insurance policies. Say, for example, I can't qualify for long-term care, or I don't want to pay a long-term care premium, but I want to access my cash value in case I need long-term care. I can use it for that. So I'm building up a well of money. It's got two legs, this permanent life insurance. It's got that insurance leg, of course, to protect your family, but to Danny's point, it's got this other leg of growth. that is really amazing when you look at the tax-free compounded returns that you can get even at 3%. And the reason why you see this slope so high is there's no risk of loss. The money absolutely compounds. So very different animals, right? That's why I created this visual. The ivory soap that deteriorates, the brick. But I'm going to pay for the brick, right? I got to know that this insurance, these premiums are going to last longer. So there are some cons that we want to go through. So we know this is for you to be spending some time with us, this is an important topic to you. So remember, we're here. Ask any questions you want in the chat. Any clarification on something, we're all here to learn. And lunch, although we'll lunch after the learn. You're lunching and learning. So we're glad you're here with us. And so again, as we are objective, we want to make sure we give you the full story. So Danny, what are some of the cons of permanent life insurance?
You know, the biggest cons that we see is that it can provide, some stress on households, especially if you get in a bind. And usually this is one of the places that people will go and cut.
Yeah.
And unfortunately, when you
payments.
cut, sometimes it's very difficult to get back. I mean, there may be some riders you can put on here that give you a little bit of protection, but those premiums are forever. I mean, you're going to typically pay them unless you have a paid up policy, which you could do that. But, the average Joe's not doing that. That's typically when somebody has come into a lot of wealth and they're looking to, mitigate taxes later in life to create that legacy intent. So we see these will lapse a little bit more frequently in that aspect. They can be a lot more complex. You can put riders associated with them, whereas a term is a term. It is essentially, it goes for this time period, and it's going to be for this amount, and that is it. And, you may be able to have that additional advantage of converting to a permanent policy, but usually there's no other moving parts, whereas on a permanent life insurance policy, you could put potentially long-term care riders. You could put a number of things that will change the way it works and the expenses of it. So we have to be cautious.
We do.
Another thing here, Rich, is that we see a lot of salespeople will flock towards the permanent life insurance policy because commissions are higher.
Yeah.
I mean, let's face it, right? It's going to be a permanent policy. It's something that's in place. The average life insurance person makes more money, or agent makes more money selling a permanent policy versus a term policy. That doesn't mean you should avoid it. It just means you need to do your homework and understand if this is something that's right for you. And I think this is where, we talked about Dave Ramsey. I think this is where he gets a lot of his, talking points, in the sense that, I've talked to a lot of life insurance people, and, some of them will say, well, I'm going to go get my license for this simply because I need to sell variable life insurance.
Right.
Well, everybody needs a policy. Well, really? Well, how do you use it? And the problem is a lot of people don't even understand, some of these agents, on how it should technically be used. And maybe they can't shop it either. We would prefer to work with, somebody who's independent that can go out and shop many of these different carriers, make sure it's the right one for you and your family, and you're getting the best deal. So this is where, when we see the higher commissions, we want to always be careful as far as what we do, and make sure that you really understand. So you need to understand exactly what you need, why you need it, and how it will be used, not just now, but later in life, and make sure that you're using these properly. And then understand if you're going to be able to use this for a cash accumulation vehicle and take loans, make sure you understand the loan mechanism and what the impact of the death benefit will be later on. Most people aren't using it to pay it off, but you want to make sure that this is used properly for you and your household, which you hear Rich and I say this a lot. This is why that holistic viewpoint, which will take you down the path of doing a financial plan. We think that's so important. And this is another aspect that we believe is something that everybody should be looking at.
Yeah, and a few things to keep in mind is, think about this permanent insurance as this brick walkway. And I want you to think about the riders as, at a park, you got benches along the way, alongside those paths. Well, how many benches do you need? In other words, make sure you're planning your riders appropriately. There are riders that allow you to access money sooner, and so forth. But, there's commission on these riders, and there are higher expenses. So you got to plan your riders really carefully. Like long-term care rider can work very well. Nursing home riders can work very well. But you've got to know your situation to understand the riders that you need. It's very, very important. Also, as you take policy loans and illustrations are done, there's a few ways. You can take lump sums. You got a big expense that's coming up. Some people, for example, during the financial crisis, we had to advise them to go ahead and leave their portfolio alone, draw their income from their policy loans, which were technically tax-free. And then we actually paid those loans back, even though to Danny's point, you don't have to. So the permanent bucket, the well of cash gives you something available if an emergency comes up or you need a lump sum payment. Or I just want to periodically take money out to supplement my retirement, but I'm not going to drain my death benefit. So it's a balance that your life insurance or financial advisor can help you with. But we want to give you some really strong guardrails. First of all, you always purchase insurance with need for insurance or a death benefit to loved ones or to preserve an estate as a legacy. Life insurance is to insure life. So you want to do the best of both. You might say, listen, I want to leave my children some money, but I also want to tap this for my retirement, but I don't want to drain it totally. I do have a need for life insurance. I have a legacy intent, and I want to do that for them. Or I want to do it for a spouse or a friend or a charity. And then I want to look with a company that has a long track record, whether it's paying dividends or has just been around a long time. We want to make sure. And I always tell Danny this. If I could do the savings thing all over again, I would do and I tell my daughter this, she's 23. Roth, max out my Roth 401k or my Roth IRA. And then I am going to set up a permanent life insurance policy. So if you are a high wage earner and a really good saver, you maxed out your tax-free vehicles, you maxed out your tax-deferred savings, your plans, and you go, gosh, Danny, Rich, I've got all this other money. What can I do with it? And I do have a life insurance intent. Well, great. We can allocate this into a bucket in your permanent life insurance and let that grow over time. It's great, right, Danny, for high wage earners who want to save and accumulate wealth over time. This is how some of the biggest people, as far as wealth accumulators, this is what they have used. The J.C. Penney's, the Vanderbilts, all this. They use life insurance to build their wealth. And this is how they did it, through permanent life insurance. Again, we try to look at things objectively through RAA insurance. And Danny said it first, and I'll let him continue on this path, but planning first. How do you purchase life insurance, Danny, or any kind of insurance, if I don't know how much I need and I'm just using these rules of thumb? Don't I want to know this is exactly how much life insurance I need before I even continue? I don't even know how you buy insurance without planning first.
I don't either. You need to be extremely surgical with this. And so we want to back into these numbers. And It's not just the things that we talked about earlier, but okay, how many children do you have? What do you intend? Are they going to private school? What does that cost? What does that inflation look like? What does college look like? You have an intent that they went to your alma mater and that was a private university that is extremely expensive. Okay, let's talk about what that looks like in 10, 15, 18 years. Those are things that we can start to back into. Now, we can be as surgical as you want. And we find that with anything, what you put in is what you're going to get out. And so we would rather be as close to the numbers as we can be. And I think that you need to understand, what's important for you and your family, and you need to write a list. So just like we have a pros and cons of each one of these different types of policies, you should be making a pros and cons list for you and your family as far as each one of these and how you would use one. I think you can use them all for a different purpose would be the intent that I would see most people using them. And I think that these can be a valuable tool, like you just mentioned, Rich. We want to look for companies with those long track records. They pay their dividends consistently. We also want to make sure that even if you take a loan out, that doesn't disrupt the dividend payments that you receive. We want to make sure that you're getting those funds credited, and they'll credit them on the funds you even take out as a loan. So that's a pretty neat way that you can utilize some of these policies.
So, Danny, you brought this up about overfunding.
Correct.
And that is like, okay, here I am. I'm a good saver. I'm at my peak earning years. Now, what you're going to tell me is, well, Rich, your premium for the year is, say, $30,000. And I'm going to say, Danny, but I've got like more money in cash that I don't need. Correct. Well, then we can call the insurance company and say, well, how much can, Rich fund his life insurance before it doesn't become life insurance anymore? In other words, this is what Danny called the modified endowment contract, right? I got to fund it just enough. Well, guess what, Mr. Rosso? You can put in another $25,000, and it'll still be classified as life insurance, and it won't, blow up your policy. Oh, great. So I'm using, and that's going to go right into my cash bucket, right? Anything above my premium is going to go right into my cash bucket. So it's another way to save for retirement. So, but you call your insurance company, they'll let you know what the bandwidth is on how much more you can fund every year.
It is. And Rich, you just provided a pretty big number for a lot of people out there. And so to give you an example, I just helped somebody look at one for, we backed into the numbers saying, okay, you max out the 401k, you're putting funds here, savings is done, you have a financial vulnerability cushion, you have all the
done all the right
funds,
things first, right?
Everything is there. And I said, you know what? I have this extra, $8,000 to $10,000 every year. I'm not sure what to do with. I like to get the most bang for my buck and tax efficient use longer for distributions. I want multiple sources of income down the road. And so we backed into the number and said, okay, well, here's the minimum. We wanted to say, well, what if you don't get that 8 to 10 every year? Here's what that minimum is, but the maximum that you're going to be able to put in is 11. And then we're able to utilize that contract where if he puts in less, we're not going to get the growth that we would expect or want. But the intent will be is that pretty normally, or pretty, with regularity, he's going to be able to put in this $8,000 to $10,000, and that's going to help accelerate that growth longer term.
You know what's interesting, Danny, because you just jogged my memory here a little bit. Think about some people that get big bonuses.
Yeah.
And they don't know what to do, right? They say, oh gosh, I got all this and I want to save it effectively, and I've maxed out all my plans. Well, I could just maybe make one-time purchase into my whole life. I could make a big lump sum purchase, right? Make sure I have money outside to pay taxes and all that. But this is what I got left, and I really would love to save for retirement, but all my vehicles are gone. That I've maxed them all out. I've done a good job. Okay. Put one lump sum into a permanent life insurance policy, and let's project it out and see how it works. So yes, the life insurance intent must be there first. But second, there is another leg to this that's not available for term. And we have some great insurance people with us, don't we?
Yeah, we do have some great in-house insurance people. So look, we were just intending to cover the basics today between term and permanent policies. There's a lot of different types of permanent life insurance, from whole life to indexed universal to variable universal life. There's a lot of moving parts, and we'll cover those in future webinars in more detail. But this was really just intended to give you the basics to help you understand, or maybe just think about it in a little bit different way. So if you have questions, obviously we're asking here, we're answering them here in the YouTube chat. But if you have any specific questions, feel free to contact Chris Liebem. Chris is our in-house insurance guy. He does a fantastic job, lots of industry experience with lots of different carriers as well. And this is something I think is really extremely invaluable for somebody to be able to go out, contact somebody, and who's also going to look through it through that holistic lens. We find that is extremely important as well, as we've shown. So keep that in mind. His information's right here. Please feel free to reach out. Also, if you're not already, we have multiple ways of communicating. So realinvestmentadvice.com, that's our daily, we have a daily market commentary. We have a weekly newsletter and a conveyor belt of information. We're typically publishing articles each and every day. So you can really get an insight as far as what's going on in the markets, the economy, and financial planning. What rules and laws are changing. We provide a ton of information there. You can also check us out at YouTube, where I'm assuming most of you guys are right now. So The Real Investment Show, we have lots of information, a daily podcast, which if you are in Houston, it's also on AM 700. You can tune in on your drive to work, or you can catch us later. Go subscribe, hit the like, hit the subscribe button. We'd love to see you guys here each and every day as we provide news and updates and commentary on what's going on around the world and how that impacts you and your family. So we appreciate your time today, really covering the basics of life insurance. Don't hesitate to reach out. We're going to have a brief survey here after this. Please let us know what's important to you. If you want somebody to reach out from RIA, we'd love to. Also, if there's other topics you'd like for us to cover, we'd be happy to cover those as well. Thank you guys so much for joining us. You guys have a great week.